Hello, everybody, and welcome to the Cyclical Investors Club channel. My name is Corey Kramer. Today, we're going to be looking at a true cyclical, Huntsman Corp, ticker HUN. This one came in by request down in the comments of one of my other videos. If you have a request, put it down in the comments, and I will get the ticker on the chalkboard behind me, which is getting pretty full. I just went through and added everybody that requested anything this past week, so those should all be up there. Or if I noticed I covered it in the past, I sent you a link to the video. As always, this is not individual investing advice, just how I analyze stocks. So believe it or not, I don't remember ever looking at this stock before. And I've looked at thousands and thousands of them. And it's pretty interesting, actually. So as a deep cyclical, I can take the dividend. Although some people might be looking at the dividends here. It doesn't look like they cut them back in the Great Recession, which is interesting. Just kind of held them steady. So, I mean, that's a little bit interesting, although they don't seem to have enough money to pay them. This could be a situation where you buy after a dividend cut, but we'll just look at this as a deep cyclical first, and then we'll get into kind of speculating and things like that. Okay, so first thing we want to do, after you can just look at the earnings and see that they're deeply cyclical, but we see it's a chemical company, probably some sort of commodity group. It says diversified chemicals, probably a lot of different commodity chemicals is what it looks like just by looking at their earnings and the graph and the chart. I didn't double check that. Double B plus credit rating. Would like that to be better, preferably, but it's not horrible. There's a pretty big discrepancy here in the market cap to total enterprise value, probably because the stock price is down quite a bit, but they do have some debt. That it looks like they probably had that similar situation in 2008. Again, I didn't go into super detail, but just looking at how the stock behaved and how it's behaving now, it's behaving very similarly, given what we're seeing with earnings. So let's go and see what it's done in the past and see if we can use that as a guide for maybe how to approach the stock right now. Because it looks pretty interesting from a cyclical perspective, just glancing at the chart. First of all, we know it's cyclical because this dark green shaded area went completely negative during the 2008-9 recession, and then it totally recovered. So we had peak earnings of $2.02 here. And if I shorten this graph down, it would show me year by year. Let's see if I can do it. We got up to 225 here. So earnings fully recovered in a timely manner. Took the stock price another few years to kind of get up to similar levels. But still a good recovery. And we have another downturn that happened here and another recovery, right? And that's what we want to see, both with the stock and with earnings. That's really good. Like, that's what you want. That's what provides you the opportunities for the cyclicals. Then we have another one. I almost wonder if they have connection to like oil and petroleum industry, because these cycles look to me similar to that. Remember, oil went completely negative down here. But we have another big down cycle. A lot of other industrial stocks did too, so I'm just speculating. But then we have another recovery with the COVID stimulus, both the earnings and the stock price. So that's all really good. I mean, this looks like from a cyclical investor standpoint, this is like what you want to see. I would call this kind of a decent quality business from the earnings that happens to be in a cyclical industry, and it's probably carrying some debt that makes it more cyclical. That's my quick look interpretation. So how can we potentially capitalize this? Well, you can capitalize on this. You can see that it's down a lot off the peak. So it's down over 65%, almost 70%. So looking pretty juicy. Probably when somebody asked me about this, it was a month ago, I'm guessing at least. So it's fallen even more since then. So let's go back and see kind of what happened during these past cycles and use those as a guide. I don't have this one in my spreadsheet because I never followed it before. So we're looking at a 92% drawdown. If you include about 90, we'll call it 90%. That's a deep drawdown. keep in mind, if you buy after an 80% drawdown and it eventually goes to 90, that means you went down 50%, right? Like if you bought a stock that peaked at $100 and you bought it at $20 after an 80% decline, if it ultimately declines 90, it goes from 20 to 10. So you lose 50%. And that's what people don't really fully understand when they're trying to buy these stocks on the way down. They could look at it right here when it's down, we'll call it 70%, and say, okay, that must be a good deal. I mean, it's come back every single time. That's all true. But let's say you buy it and then it ultimately falls 90%. Well, that's like paying $30 for a stock that falls down to $10, right? So you lose 65% still to go potentially if we have a similar drawdown as 2009. The earnings decline looks pretty similar to that, right? They went actually deeply. So if we put one more year on here with bad earnings, and we haven't had a recession yet, so if we had a recession on top of whatever's happening now, we could totally see this 90% drawdown, I think, happen. Now, we could say, okay, maybe it's something that's specific to that type of recession. Maybe, but probably not, because if you just look at these mid-cycle downturns in their industry, we have a 70% decline there. That wasn't even a recession. Kind of a industrial recession, but not a widespread recession. And the stock fell 70% there. And then, of course, we had the COVID bottom here, but again, we're down another, we'll call it 65%, right? So these are big declines, and they basically had a decline similar to those past two mid-cycle or mild-ish recession. Might not be mild for their industry, but wide. The thing is, you can have an industry kind of recession that's bad for you, but if the wider economy then goes into recession, they can be even worse, right? A lot of times. So that's what we need to worry about here. So for me, I think I might put this one in my spreadsheet just to keep an eye on it, because I might be willing to buy a little bit of it at a certain price. Now, I would say it needs to be about 85% off its highs probably before I'm going to be interested here. I want it to be kind of close to the bottom, because this is even though it's been a relatively good business, if it gets bad, I mean, these are the type of businesses that can go out of business. Like, you lose all your money. So it's not like you're buying Google or something like that. And so there is higher risk, and you want to get the potential reward that comes along with it. So if you bought after an 85% decline here, I didn't pick the exact bottom, and then maybe you held it up to here till it made similar highs, you could have got a 700% return. Well, let's say they were losing money this year. Let's say there was real risk of like bankruptcy or not being able to recover or whatever. Let's just say there was. To me, the risk is worth it if you can get a 700% return on the other end, or even 500% or something. So now I would still take a relatively small portfolio position, because you never really know what's going to happen. There'll probably be other opportunities in the market, and if you spread those bets around to different types of potential, returns in businesses and high quality and everything, this does, I would say, meet kind of the minimum quality requirements that I would have based on their previous earnings peaks and stock price peaks. So yeah, this is kind of the riskier end of what I would try, but you want to make sure that reward is there. So for me, like, I think you could look at like a 500% return over 5. Maybe you have to wait a little bit longer for that. How long was this? 2008 to 24. So that's like 6 years. That and who knows? Every recession is different. Just because they came back that fast, I mean, doesn't mean they'll do it again. Things can be a little bit different, but the potential we see is at least there for these pretty big returns. And so, yeah, I mean, I think if you said, okay, let's say you just give yourself a 50-50 chance, 50% chance you lose all your money or like 90% of it and they go bankrupt. The other 50% chance is you get a 500% return in 5, 6 years, 7 years. That's a fair trade-off to me. I mean, you could be wrong 5 times and still break even, on the 6th time or whatever, or be wrong 4 times. And so, and that's the sort of thing that I would probably look for and what I would. So that works out to a price of about $6.22. Call it about 50% lower than, a little more than 50% lower than where it's at right now. Sounds like a lot. If you were just looking at this, you might think, well, that's never going to happen. It's already down 70%. That's when going back and looking at the history really helps. It absolutely can happen. I would say odds are there's a good chance it could happen, right? And that's just how I would approach it as a cyclical investor. And yeah, thanks for asking for this one. It's pretty rare that I look at one that I haven't really looked at. That's not just that I don't dismiss. I mean, there isn't something I don't like about it. So this looks kind of on the edge of like the risk spectrum, but the reward is potentially worth it. And I would consider buying it, I think, and usually right before I go to buy something, I do more research on the business than what I'm doing for this video. So maybe there's some other reason that comes up that's legitimate and not cyclically related. What I would be looking for are things that are significantly different now than they were in 2009, 2008, whatever that might be. I know the news is everything's going to be bad, but I want specific things that are different, that are really going to worse this time than then with the company. But yeah, as it stands right now, in terms of valuation, $6.22, that's where I would aim. All right, thanks for asking for this one. If you enjoyed this, hit like and subscribe if you found it useful. I have weekly picks over on Patreon for $25 a month, and I also have some picks over there on the free tier that are not on YouTube. So check those links out down in the description. See everybody later.